Okay, and welcome to the lecture for part 2 of chapter 2, picking up where we left off in part 1. So most businesses, their objective or their goal is not to break even. Most businesses want to earn a profit. So we can look at that. It's just an easy extension of the formula we looked at when we did break even. If you think of break even as being a target profit of 0, then this equation makes sense. So we want to know how many units that we have to sell so that we have a contribution margin that's going to equal or cover our fixed cost plus our target profit. So I'll show you an example in a minute. The other thing we can look at, and the book talks about this a little bit, is what if we want an after-tax profit? So if we want an after-tax profit, we're going to divide the target profit by 1 minus the tax rate. So an example is, what if we have a 30% tax rate and we want to have a $70,000 after-tax income? Well, we would take 70,000 and divide by 1 minus 0.3 or 0.7. We'd see that would get us a before tax profit of $100,000 that we would use in this equation. So the example I have for you here is we have fixed costs in this company of $200,000. They want to earn $100,000 before tax profit. And we have a unit selling price of $75, a variable cost of $45. So each unit is going to give us $30 towards covering the $200,000 in fixed cost and providing for a $100,000 profit. So we want to know the number of units that we're going to have to sell in order for that to happen. So our sales in units is going to be $300,000 fixed cost plus target profit divided by the $30 that each unit is going to give us. We'll have to sell 10,000 units in order to reach that target. You can see that's a really useful piece of information for a lot of companies to have. So one point, you're probably thinking, how many companies have one single product? I can't think of a company offhand that only has one product. So what do you do if you have a whole bunch of products? And I'm not crazy about the example that the book uses about cases of wine with so many of this kind of bottle and so many of that kind of bottle. I think it's because that's also not very realistic for most companies. I mean, the company that I had, we had over 1,000 products. So what we'd look at is, what is the sales mix? So the first step here is, what is the sales mix in terms of units? So not in terms of dollars, but units. So if I sell a table and I sell 4 chairs, and then I'm going to have a mix based on those quantities. And I would determine the weighted average price. So the quantity or the mix times the price would give us a price of a blended unit. So we're going to deal with a fictional blended unit. And I would do the same thing with variable cost. So I have a fictional blended cost. Okay. So now I can take my blended weighted average price minus my blended weighted average variable cost to come up with a blended weighted average contribution margin for that unit. And now I can use that to determine what my break-even point is relative to my fixed cost. And once I determine that break-even point in fictional blended units, I can then multiply that by the sales mix percentages to get the quantity of each individual product in that mix that I need to sell in order to break even. So here's something that the book does not explain that I think is really, really beneficial. So you'll notice on the left, there's a traditional income statement. That's a GAAP format, normal looking income statement that you've seen a bunch in classes you've had before. So, and I've produced a lot of financial statements that look exactly like that. So what I used to do is I would produce internal financial statements that were in the contribution margin format. So same result, same amount of sales. It's not, like I said, a second set of books. It's a different way of looking at the same information. But now I took that cost of goods sold figure of 400,000 and I split it into variable manufacturing expenses. That might be direct materials and direct labor. And down below, the fixed manufacturing expenses of $100,000. That might be depreciation and rent and the supervisor or something like that. I did the same thing with selling and administrative expenses that totaled $400,000. I have the variable portion of $50,000 in the variable expenses. That might be commissions. And then I've got the fixed portion. That might be the rent on the office and the accounting staff and the president's salary of $350,000. So now that I've broken it apart, I get the same bottom line of $200,000, but now I can say meaningful things about what could happen in the future. And you can see here that on sales of $1 million, I have contribution margin of $650,000. The other way of looking at that is I have a contribution margin ratio of 65%. That means 65% of my sales dollars are going to flow through to contribute towards covering my fixed costs and provide for my net income. Now I can immediately say things like, what if my sales are $100,000 less? If my sales are only $900,000, I know that 65% of that decrease of $100,000 is going to go to the bottom line. 65% of negative $100,000 means that my net income is going to be $65,000 lower because the $450,000 won't change. So I know that my net income at $900,000 is going to be $135,000 if I'm doing the math right in my head. Same thing I could say, what if my sales go up by $200,000? 65% of that $200,000 increase, or $130,000, will go to my bottom line. That'll give me a net income of $330,000. So I can immediately say what's going to happen if our sales volume changes and that contribution margin ratio holds the same. The thing I liked about this contribution margin format is that it was a really good way to communicate internally how things were going in the company, because it didn't matter what somebody's background was, they could see that pattern and they could see what good things can happen, what bad things can happen. So that format is not generally accepted accounting principles, so I couldn't use that for my external financial reporting. But again, because I'm just displaying it in a different way, the results aren't different, I could switch between the two pretty easily in that way. Okay, the concept of operating leverage looks at the relationship between variable costs and fixed costs. So think about a company that has outsourced most of their production, so most of the product that they're selling, they're buying from other suppliers. That means that their product costs, the cost of their product, is almost entirely variable. They don't have supervisors, they don't have depreciation on machinery, they don't have factory rent. So those companies would have high variable costs, low fixed cost. They have a low operating leverage. Companies with low variable costs and high fixed costs, maybe they do all of their own manufacturing, so they've got machinery that's depreciated and supervisors and rent on a factory and all of that, they're going to be in a different situation. So companies with low operating leverage have less risk. So if their sales fall, they just order less parts from their supplier. They don't have to worry about keeping their factory busy. So there's less risk. There's also less upside because they have high variable costs. They're keeping less of every sales dollar. There's less contribution margin from every sales dollar. So if their sales increase dramatically, they're not going to become way more profitable. On the other hand, companies with high operating leverage have low variable costs, so they have high contribution margin. So as their sales increase, they have much more upside potential, but they have more risk of downside, bad things happening. So next I want to talk about cost classification. So these are just different ways to classify. This is not mutually exclusive from fixed, variable, and semi-variable. This is just a different lens to kind of look at costs at. So in this case, we have product cost and period cost. So product costs are all of the cost, which can include variable and fixed cost, that are required to manufacture a product. When you look at a list of costs and you say, is that a product cost or not? My question would be, if I stop making product altogether, would that cost go away? If it's depreciation on a machine, yes. If it's direct material, yes. Direct labor, yes. Indirect labor, yes. So if it's a manufacturing cost, that means it's a product cost. It's going to attach itself to the product, and it's going to follow that product through the system. So it's going to accumulate an inventory, and it'll only hit our income statement as an expense when we put it in the back of a customer's truck, when we sell it. That's when it becomes cost of goods sold. So if an extreme example, say we have a month where we really work our factory, have a lot of employees in there making parts, we consume a lot of materials, use up a lot of electricity, all of that, and we don't sell a single thing. We don't sell any product at all. We're filling up our warehouse. None of those costs would be reflected on our income statement. Our cost of goods sold would be zero because we have not sold any products. So there can't be a cost of goods sold. It would all be in inventory, and it would be in the next month's cost of goods sold when we hopefully sell those parts. In contrast to that, a period cost are all the other costs in the business. So advertising, office salaries, insurance, all of the other costs that are not product costs are going to be period costs, and they're expensed as incurred. R&D expense, all of those kinds of costs are expensed as we incur them. Another way of looking at cost is to look at direct cost versus, the book uses the term overhead. I like the term indirect cost. So a direct cost, and this is more of an art than a science in terms of where you draw the line. So a direct cost is all the costs that you can trace directly to a product. Okay, so you can take it a little bit too far. So it's a cost benefit thing. So how minutely do you want to measure that versus the benefit of having that extra knowledge? So in our picnic table example, the lumber that goes into the picnic table, the 2x6s and 2x4s, that's a direct cost. I can see them in the picnic table. The bolts that hold it all together, that's a direct cost. I can see it. Direct labor. That's people putting their hands on the product either directly or through a machine and altering the product. So the person that cut the boards, the person that drilled the holes, the person that assembled it, that direct labor is a direct cost. So indirect costs are all other manufacturing costs that are not direct. So an example of indirect material would be maybe I used a little bit of glue and I used some sandpaper that got used up in making that picnic table. Now technically I could measure how much glue went into each picnic table, but with knowing 1.5 cents versus 3 cents, that doesn't really make a big difference. So usually we just include that in indirect costs and then we allocate it through some rational mechanism. So indirect materials would be small materials that get used up in making the product that are not consequential enough to measure and maybe can't be seen. Indirect labor would be things like supervisors, forklift drivers, quality control inspectors. Those are all people that are a necessary part of the production process but aren't physically altering the product. And then we'd have factory overhead, which would be the lights in the factory, the depreciation on the equipment, the utilities for the factory, electrical, that sort of thing. One thing I don't have on my lecture notes that is in the book and that is important is the term conversion cost. So conversion cost is direct labor plus all factory overhead. So it's the cost to convert direct material, like a pile of lumber and some bolts, into a finished product like a picnic table. Conversion. So a couple different cost estimation methods, an easy way and a better way. So the easy way is just to take an income statement and identify each cost as being fixed or variable based on your knowledge of what the cost is and how it changes. It's not very precise, but it's pretty easy to do. It doesn't take a whole lot of effort to do that in many companies. And then you could do that contribution margin form and income statement and make some predictions. A better way to do it is time and motion studies. That's where you actually observe things that are taking place in a factory, measure the amount of time it takes, and look to bills of materials and production drawings to see how much material is consumed. In some cases you have waste or scrap, and so it takes an effort to say, well, you started out with 1,000 feet of wood and you threw away 100 feet to make the product, so the cost of that scrap gets included, those kinds of things. So it's much more time consuming, but it's a much more accurate way to do it. Some of the challenges in doing that, what I have found in doing motion studies in factories for direct labor cost, is it's really difficult to measure what the true cost is, because just the very act of measuring something changes how people do their jobs. Maybe they sandbag and do it not as well, so they know the bar isn't set as high for doing a good job, or they go the other direction and they try to do really, really well, and then you're measuring an optimal situation versus something that's the truth. So that can be difficult to do in the best situation. So I want to show you a real-world example of cost, volume, profit that's pretty current right now. And this is a simplistic example for sure, but just to give you an idea of how people might use this. I've used these methods in consulting for local businesses, so I know it has a direct application. So in this example here, we have a small restaurant in Olympia. And in the month of February, before the COVID-19 crisis hit, before we had a stay-at-home order, we served 200 meals a day, average price of $20 a meal, and we had food and beverage costs and labor cost. You notice I have very precise percentages there. There's a great website called bizstats.com, bizstats.com, and they collect financial statements from thousands of small and medium-sized businesses, and they give a common size income statement for benchmarking. So you can pick any kind of business and go there and see what an income statement looks like on a percentage basis for that. So that's where I got 41% and 19% for restaurants. So I can figure that variable cost. I see they have a contribution margin of $48,000 or 40%. And then they've got some fixed costs like rent and advertising, and you can see all of the others there. So they made a profit of $11,600, which in effect is the owner's compensation for owning the restaurant. So now we can see, well, what happens if stay-at-home orders go in place, phase one, and we have no sales at all? Okay. So that's pretty easy to do. 0 sales times $20 is 0. We're also not going to have any food or beverage or labor to worry about because we don't have cooks and waiters and all of that. But we still have those fixed costs. They stay the same no matter what. So now in the month of, let's call it April, we have net income of a loss of $36,400. So then the question is, we enter phase two, which I think is going to happen pretty soon in Thurston County, where they can be at 50% capacity. So let's assume we can be at 50% capacity, so we can serve 100 meals per day. What's that situation look like? So that situation looks like lower revenue, but also lower variable costs. So now our contribution margin is $24,000. So we have a loss of $12,400. So the question would be, should we do it? Is it worth opening at 50%? Well, the answer is yes. I would rather lose $12,400 than $36,400. So while we still have a loss, it's less of a loss. Now, of course, this is the assumption that we can't reduce our fixed costs, which maybe we could do. So that's one way of using this kind of format and this kind of thinking to say, what if, and should we open or should we not open, or what can we do about things? Now, the next question that somebody would probably ask if you were the controller for this restaurant is, at what level would we start to at least break even? What level of occupancy would we have to be at to have 0 on the bottom line? So we can use our break even to do that. And here I'm going to divide by that contribution margin ratio, because I don't want units, I want sales dollars. So if I divide fixed costs by the contribution margin ratio, I'll get sales dollars. So remember, my contribution margin ratio was 40% from a previous slide there. So what I'm asking here is, how much do I have to sell so that 40% of it will cover 36,400. That's the logic of that math. And the answer is I'd have to have sales of $91,000, which equals 76% of what my normal volume is. So if we could open up to 76% and still be safe, we would at least break even. So that's an example of how we would use what I've talked about in this chapter to address a real situation that's going on right now. So I hope that makes sense. Please, I'm going to try to keep these lectures to the 20 to 30 minute range. That's kind of an easier thing to swallow. If you have any questions, please don't hesitate to shoot me an email or give me a call. And good luck with your assignment for the first 2 chapters. Thanks.